Please welcome Nedbank Group Chief Executive, Mike Brown.
Good afternoon and welcome to everybody online via the telephone lines and for the first time via LinkedIn. I would like to start off by thanking all our committed Nedbank employees for remaining resilient and serving our clients so well during the challenges we've all experienced over the past 2 years. I would also like to extend our deepest condolences to the families, friends and communities of employees and clients who've been impacted by COVID-related deaths during this time. 2021 was also a year that saw the sad passing of our chairman, Vasi Naidu, after a long and brave battle with cancer. At Nedbank, he led the board with both integrity and passion, and he loved our Nedbank brand and what it stood for. We will be forever grateful for his contribution during his tenure. Mpho Makwana, who was previously the lead independent director, has seamlessly stepped into the chairman role. Turning now to the format of today's presentation, as shown on this agenda slide. In my overview section, I will start by covering the operating environment in 2021, which, while being difficult, was materially better than 2020. Key highlights from our financial performance, some data highlighting our strong operational performance, and then an update on the progress we continue to make in key areas of strategic focus, particularly the important areas of digital and ESG. After my overview, Mike Davis, our CFO, will follow me with a more detailed analysis of the group's financial performance in 2021, after which each of our frontline managing executives will cover the financial performance and strategic drivers for each of their respective business clusters. I will then come back at the close to review the outlook for 2022, as well as the good progress that we've made towards our medium-term targets through to the end of 2023. You will notice, as usual, that some of the slides are marked booklet slide in the top right-hand corner, and these are additional information slides for investors, and we will not speak to any of these directly. 2021 was a more supportive environment for banks and our clients, as GDP recovered off the low 2020 base. Overall, demand for corporate credit was muted, and excess cash generated by our clients, in particular in the commodity sector, was generally used to repay debt. We did, however, see some growth returning towards the end of the year, evidenced by our wholesale advances portfolio in December finishing above June levels. On the retail side, demand for credit was more robust, as clients benefited from the lower interest rates. Pleasingly, we saw less negative economic impact from COVID-related lockdowns than we had expected in the fourth quarter, and this was beneficial to us and our clients as transactional volumes improved faster than we had expected. We delivered a strong financial performance, with headline earnings up 115%, but they are still 7% below 2019 levels. The turnaround at ETI continued in terms of both earnings, liquidity and capital, demonstrated by a resumption of ETI dividend payments, and these all taken together resulted in a strong improvement in the ETI share price off a low base. As I noted at our interim results, a standout feature of our performance in 2021 was the excellent outcomes achieved on closing out the resilience phase of the COVID-related strategic pivot we introduced in March 2020. All measures of balance sheet strength that we refer to as resilience metrics are now not only above 2020 levels, but back above pre-crisis levels, all much faster than we had expected, with our CET1 ratio at 12.8% being above the top end of our board target range, enabling the H2 dividend declaration at the low end of our cover range. Operational metrics improved into the second half and were also better than we had expected, evidenced in pre-provisioning operating profit growth of 9% and a positive jaws ratio. From a strategic point of view, we continued to see the benefits of digitization, delivered through what is known as our Managed Evolution IT program, and this is driving continued improvements in client experience metrics, market share gains in a number of key areas, including main bank clients, as well as improved productivity metrics. We also maintained our focus on leading in ESG matters. Reflecting on the operating environment, and in particular COVID-19 infection rates and lockdown levels in a little more detail. Following the Delta variant that started in June, the start of the Omicron or fourth wave at the end of November initially created significant uncertainty. While Omicron has proven to be more contagious, thankfully the reduced viral load alongside increasing vaccination and other immunity levels has resulted in less hospitalizations and deaths, and therefore reduced pressure for hard lockdowns. As a result, South Africa stayed at lockdown level 1 during the fourth wave, compared to our shift to lockdown level 3 during the third wave. This is evident in the graph on the right, being our position at the lower end of the Oxford Stringency Index versus other selected emerging markets. Turning now to a chart that you will all be familiar with, Nedbank's own high-frequency data from turnover on our point-of-sale devices and through our digital channels over time. The graph on the left shows how the COVID pandemic played out in this view of client activity levels over the last 2 years, with grey bars representing the months in 2019, the dark green bars months in 2020, brighter green bars months in 2021, and the violet bars months in 2022 to date. Previously, we have discussed with investors the large decline evident in April 2020 during the very strict lockdown levels as COVID first hit South Africa, as well as the recovery that we saw into the second half of 2020. And we now see this continuation into the first half of 2021. Pleasingly, we saw turnover levels accelerate even further in the second half of 2021, evidence of the continuous opening up of the economy. By way of example, transactional turnover volumes in the fourth quarter of 2021 were 23% higher than the fourth quarter of 2020 and 35% higher than the pre-COVID levels of the fourth quarter of 2019. The recovery has not been even across industries, as we can see on the right-hand side. And while all industries now exceed the pre-COVID March 2020 level, hotels and airlines are still below average 2019 levels. From a corporate banking point of view, activity remains constrained and business confidence levels remained below 50, although pleasingly, some green shoots are emerging. We've seen some positive progress, albeit slower than we would have liked, on structural economic reform, and the focus in the recent State of the Nation address and budget on aspiring to both higher levels of economic growth and fiscal sustainability is welcomed. Some of the important reforms as we see them are listed on the right of this slide. In the context of renewable energy, Nedbank, as the green bank, continues to be well positioned, participating and co-leading 4 of the emergency energy projects. We did, however, secure a smaller than usual participation in renewable energy round 5, largely due to very competitive pricing. Round 6 bids are expected to be opened soon. While we remain appropriately cautious, it is pleasing to see the emergence of a number of green shoots in the wholesale environment. From a retail or household perspective, the operating environment continued to be more supportive. On the left, we show how households have delevered, allowing them to take advantage of the lower interest rates over the past 24 months, and this is evidenced in solid demand for prime-linked credit products. The lower interest rates have also been beneficial to clients as debt servicing costs reduced, and this improvement in client cash flows for those who have remained employed is evident in lower credit loss ratios across all our businesses. Lastly, while impairments in 2021 were below our initial expectations, there are some early signs of increasing pressure on some consumer segments from increases in transport costs, electricity and food prices, and we are monitoring this carefully. Turning now to our strategy and targets to 2023 that we announced after COVID hit and shortly after we withdrew previous targets that were no longer appropriate given the material changes in both global and South Africa macroeconomic outlook post-March 2020. I will provide an update on our progress on our medium-term targets in my concluding remarks. But just as a reminder, we set ourselves key medium-term targets that we wanted to achieve by the end of 2023 as shown in the top row of this slide. Getting back to the 2019 levels for diluted headline earnings per share and ROE, reducing our cost-to-income ratio to below 54%, and to rank number 1 on Consulta Net Promoter Scores. We identified 3 strategic value drivers, as shown in the middle of the slide, and we believe that delivering on these 3 will enable us to meet our financial targets. These drivers are growth, productivity, and risk and capital management. Underpinning the delivery of these are 5 strategic value unlocks, or programs of action, that you can see listed at the bottom of the slide. In the next few slides, I'm going to step off from this foundation and track our progress on these 3 strategic value drivers and 5 unlocks. Starting now with the first 2 of the 3 strategic value drivers. On growth, we have made good progress, as you can see on the graph at the top left. NII, NIR, and advances growth have all turned positive, and we would expect these trends to continue into 2022. On the bottom left, from a client growth perspective, we recorded ongoing CIB primary client gains, growth in retail main banked clients, growth in clients in Nedbank Africa regions, and a 13% growth in assets under management. On the productivity side, on the top right, pre-provisioning operating profit increased 9%, and in the second half was up 21%, while our cost-to-income ratio decreased, both including and even more so excluding fair value movements that are not reflective of underlying operational activity. On the third strategic value driver, risk and capital management, we believe this is best represented in the excellent delivery of our resilience metrics to close out this phase of our post-COVID strategy. These provide a very strong balance sheet base for Nedbank to support both future business growth as well as attractive growth in dividend payments. Starting at the top left of the slide, given our strong financial performance and successful focus on RWA optimization and margin expansion, particularly in CIB, our CET1 capital ratio at 12.8% ended the period higher than pre-crisis levels and also above the top end of our board target range. On the top right, these strong capital metrics have enabled us to declare a final dividend of R7.58 a share at 1.75 times cover at the low end of our 1.75 to 2.25 target range. This brings the cover range for the full year to 2.02 times. Moving to the bottom left, liquidity metrics such as LCR and NSFR are strong and higher than pre-crisis levels. On the bottom right, from a credit point of view, our credit loss ratio declined to within our through-the-cycle target range faster than we had previously expected it to, and our ECL coverage is at a multi-year high of 3.32%, highlighting ongoing prudency in provisioning, which is appropriate in uncertain times. Turning now to our 5 strategic value unlocks. I'm going to start with a reflection on our digital strategy that is delivered through what is known as our Managed Evolution technology journey, that is an enabler of many of these unlocks. We continue to make good progress on our goal of digital leadership, underpinned by our Managed Evolution tech strategy to build a modern and modular IT stack. Investors will be very familiar with this from previous reporting. We've now reached 85% completion, and in the first half of 2021, completed an independent external benchmarking review of our ME program and its business case, with very pleasing outcomes that underpin our ability to compete and win in digital financial services. On our new client onboarding platforms, individual digital onboarding through Eclipse is fully in place, and we have completed the build of juristic onboarding through the Nedbank Business Hub in our wholesale business, and client rollout is well underway with excellent feedback. Anel Bosman will refer to this later. We have digitized 6 retail products, or client journeys as we call them, being transactional accounts, personal loans, card, investments, overdrafts, and home loans. Importantly, from a cost point of view, we have seen the annual IT cash flow spend peak in 2017 at 2.3 billion rand, and in 2021, cash flow spend was 1.6 billion. The 85% maturity of the ME program also gives us comfort that the intangible software asset on our balance sheet is likely to have peaked in 2021 at around 9 billion rand, with little risk of material overspends remaining in the program. Lastly, it's always good to get some independent acknowledgement, and we were pleased to have won various awards for our digital journey and its impact on client experiences, and you can see a number of these in the center of the slide. Turning to the key trends on digital uptake and usage that evidence our ability to use the Managed Evolution technology platform to deliver market-leading client solutions. We continue to see pleasing acceleration of digital uptake and usage across multiple metrics, including active clients, product sales, as well as digital volumes and values. Digitally active clients increased further on both a total and main banked client basis. Digital sales increased over the past few years to now reach 32% of total sales. Digital transaction volumes and values have increased by 50% and 21% respectively since 2019. And the trend towards usage of Nedbank banking apps is even more pronounced, with a 96% increase in active app users, 159% increase in app volumes, and 163% increase in app value transacted. In addition to our traditional digital products and solutions, we are also innovating in the so-called platform or ecosystem space in the form of ongoing disruptive market activities, this being our second strategic value unlock. Over the past 2 years, we've highlighted to investors some of our platform or beyond banking initiatives, built off those foundations of the Managed Evolution. Some of these are shown in the middle of the circle, including Avo, our super app. In respect of Avo, starting on the left, registered clients on Avo increased in 2021 to more than 675,000, up almost 5 times from 2020 levels, while gross merchandise value increased 3 times. Our initial aim was to exceed 1 million Avo users in 2022, but given the progress we've made to date, we are well positioned to exceed this. As of last week, we had already achieved 1 million users on Avo. The number of merchants and partners on the Avo app also continued to increase, making Avo an attractive digital store, with more than 20,000 business partners providing more than 250,000 products across 11 different vertical categories. The benefits from our Managed Evolution tech investments and digitization are driving both digital customer experience, as we've just seen, as well as a more efficient execution, and these benefits are being unlocked through our target operating model programs. In 2020, we concluded TOM 1, which unlocked 2 billion of benefits, primarily derived from moving to an agile methodology to build these IT assets, as well as from onboarding and innovation methodologies in our digital fast lane. TOM 2, which we launched in 2021, is led by our Chief Operating Officer, Mfundo Nkuhlu, and primarily focuses on what happens after our digital platforms are in place, being optimizing the shape of our physical infrastructure in a more digital world. You'll hear Tsiko Thomas talk of Project Imagine, as well as embedding a more client-centered and efficient operating structure in RBB. Here you will hear Tsiko talk of Project Phoenix. In addition, we are also optimizing group-wide shared services to be fit for purpose to support our more digital client-facing operations. TOM 2 benefits of 967 million rand were unlocked in 2021, and we are well on our way to a target of 2.5 billion by the end of 2023. The benefits of our TOM programs are evident in improvements in key operational metrics that you can see on this slide. As more products and processes are digitized and our customer behavior changes, over the past 2 years, we've been able to reduce headcount by 8%, largely through natural attrition, and branches by 9%. On the bottom right, we're also now seeing a slowdown in the growth in the IT amortization charge, driven by slightly lower levels of IT cash flow spend, as I highlighted earlier. Turning to our focus of growing in attractive areas for value creation, or Strategic Portfolio Tilt 2.0, where we target growth in key lending categories as a foundation for growing our transactional banking franchise by focusing on main banked client gains and cross-sell. Notwithstanding tighter credit criteria and generally lower approval rates, we've seen increases in market share in personal loans and retail overdrafts, enabled, amongst others, by our digital innovation and channel expansion. And we would aim to continue to grow our personal loan market share over time while operating within appropriate risk appetite metrics. In home loans, we grew slightly below the industry, but still plan to increase our share over time. We increased our share in vehicle finance, where our unique MFC business model positions us well to benefit from consumers focusing on lower cost and second-hand vehicles. We reduced market share in wholesale term loans and commercial property finance, where we have been deliberately selective in origination and focused on optimizing the portfolio, evidenced in the strong increase in CIB margins. On the deposit side, outcomes were mixed, as we increased market share in commercial transactional deposits, but disappointingly we lost some share in retail transactional deposits, although we have seen some more positive trends in the fourth quarter of 2021, and Tiko will talk to this in his presentation. At Nedbank, our purpose is to use our financial expertise to do good for all our stakeholders. Through our fifth and final strategic value unlock, we focus on creating positive impacts and driving sustainable socio-economic development wherever we operate. One aspect of our purpose is demonstrated through our market-leading energy policy that seeks to guide a just transition away from fossil fuels while deliberately accelerating efforts to finance non-fossil fuel energy solutions that are needed to support socio-economic development and build resilience to climate change. For South Africa to achieve our ambitious carbon targets will require a significant amount of investment in energy-related innovation, and this is a large and exciting opportunity for Nedbank to lead on into the future. Ongoing progress on this includes Nedbank's issuance of Africa's first Green 81 instrument, and Anel Bosman will expand on some other initiatives in CIB later. The total amount of sustainable funding that has been raised by Nedbank has increased more than 3.5 times since 2019 to just shy of 10 billion rand. On the lending side, at the end of 2021, our renewable energy portfolio linked to REAP was 29 billion rand, and we have a 50 billion rand board limit in place to accommodate much more future client lending support, and a strong embedded energy generation pipeline is also in place, in particular following the recent lift to 100 megawatts of capacity. Turning to our contribution to social matters as viewed through the lens of SDGs, this slide shows various highlights of our progress. I'm not going to talk to all of them, but will highlight a few. On the financing side, on the left, to date we have provided more than 5 billion for student accommodation, 57 billion for loans to SMEs, 5 billion for affordable housing, and 25 billion for the construction of buildings that conform with green building standards. In our own operations and through corporate social investment, in 2021, we spent 121 million rand on philanthropy, of which 47% was allocated to education. We have 87% of our own buildings Green Star rated and have been carbon neutral since 2009. After a COVID-related pause, we restarted our participation in the Youth Employment Service in 2021 by providing more than 1,900 one-year job opportunities to unemployed youth. And we encourage all South African corporates to do the same. We have continued to improve diversity metrics across the group and have maintained our level 1 BBBEE status for 4 years in a row. Turning to governance and board-related independence and diversity metrics have all tracked positively. From a culture point of view, our workforce sentiment continues to improve and attrition levels remain low. Lastly, with increasing focus on ESG matters, the progress we have made on these continues to be reflected in Nedbank's scores across all ESG ratings, being towards the top end of our local and international peer group. In closing, in 2021, 2 corporate transactions were also concluded. On the left, following the unbundling in 2018 by Old Mutual of 32% of Nedbank, on the 8th of November 2021, Old Mutual concluded the unbundling of a further 12.2% of Nedbank to its shareholders, with Old Mutual at the 31st of December 2021 now owning just over 5% of Nedbank. Pleasingly, notwithstanding the unbundling of around 221 million Nedbank shares by Old Mutual since 2018, we did not see any material negative impact on the share price relative from this, as a large increase in our free float resulted in an increase in index-classified shareholders as well as foreign shareholdings. On the right-hand side, we also successfully concluded the repurchase of 100% of the Nedbank Limited preference shares that no longer count as regulatory capital and had therefore become expensive debt. I will now hand over to Mike Davis, our CFO, to take us through a more detailed review of the group's financial performance.
Thank you, Mike, and good afternoon, everyone. I'm pleased to report that the group delivered a strong headline earnings recovery, which was ahead of expectations, while our ROE increased to 12.5%. I will unpack the underlying drivers in the next few slides. 2021 was a much better period for banks and our shareholders. Looking at the key drivers of value creation, net asset value per share increased by 11% to just below 205 Rand per share, implying a price-to-book ratio of around 0.9 times at the 31st of December 2021. The group's ROE improved to 12.5%, but is still below the estimated cost of equity. And as Mike mentioned earlier, we paid a final dividend of 758 cents. All of the group's profitability metrics improved, as seen in the very strong headline earnings, DHEPS and EPS growth, and this was in line with the trading statement we released on the 14th of February. Our balance sheet remained resilient, with stronger liquidity and capital positions well above regulatory requirements. Our credit loss ratio decreased to 83 basis points, with total coverage increasing to 3.32%, a multi-year high. Turning to our usual waterfall graph, where we show the key drivers of the headline earnings increase, NII increased by 8% and NIR by 4%, the latter improving from the decline of 3% in half one. Impairments decreased by 50% and was the key driver of higher headline earnings, as is clearly evident in the graph. Associate income increased strongly off a low base, and Terence will unpack the performance of our associate ETR in more detail later. And lastly, expenses were well managed at 6%. Pre-provisioning operating profit growth of 9% was strong, supported by growth across all of our business clusters and driven by higher revenue growth in the second half of the year. As a result, PPOP growth accelerated in the second half of the year to 21%, with CIB, RBB, Wealth and NAR reporting growth of 16%, 6%, 31% and 156% respectively. Reflecting on the balance sheet, gross banking advances increased by 1% after declining by 7% in the first half. Noteworthy on the left is the turnaround growth in CIB banking advances in the second half of the year from a sharp decline in the first half as our corporate clients used excess cash to reduce their facilities. The growth momentum in RBB continued as banking advances continued to grow by around 7%. On the other side of our balance sheet, deposits increased by 2%, driven by good growth in transactional and core deposits, evident in CASA and call and term deposits growing by 5% and 8% respectively. Pleasingly, our reliance on wholesale funding continued to reduce, as seen in an 18% decline in NCDs and the contribution to the group funding mix decreasing to 32%. Turning to the income statement, NII increased by 8%, driven by a 37 basis point increase in the net interest margin. The increase in NII was better than expected and was driven by a 13% endowment benefit from higher CASA and capital levels, offsetting a 14 basis point adverse impact of interest rate decreases from 2020. The benefit of asset mix and pricing continued as higher margin RBB loans grew faster than lower margin CRB loans, and we were able to price upwards across most products. This contributed to a 20 basis point increase. Liability mix and active balance sheet management were also strong contributors. Importantly for Nedbank, in a rising interest rate cycle, we are positively positioned as NII benefits by approximately 1.6 billion rand for each 100 basis point interest rate increase over a 12-month period. Unpacking NIR, growth increased by 4%. The key drivers include commission and fees increasing by 4%, primarily as client transactional activity recovered, main bank clients grew, and we increased levels of cross-sell. Trading income decreased by 15% off a very high 2020 base. The trading performance, however, was solid and normalized to around 2019 levels. Insurance income increased 24%, driven by an enhanced asset and liability matching strategy and improved investment performance in our insurance business. Equity revaluations, up more than 100%, reflect the non-recurrence of negative revaluations in 2020. And lastly, fair value income declined by more than 100%, given the unwind of the 2020 gains as a result of accounting mismatches in the group's fair value hedge accounting solution. Pleasingly, we saw no further volatility in the second half of 2021, and this volatility is not expected to recur in the future through refinements to our fair value hedge accounting solution. Insurance income was favorably impacted by strong investment returns due to a positive market rebound, as can be seen in the JSE All Share Index in the graph on the right. This was partially offset by increases in death and funeral claims in the life portfolio, although reducing towards the end of the year. Asset management delivered a robust performance, driven by stronger growth in assets under management of 13% to 424 billion. This growth was underpinned by positive net flows both locally and internationally, as well as a steady increase in market share. Turning to impairments, the group's balance sheet expected credit loss and ECL increased to 26.6 billion rand and is also higher than the 18.2 billion reported in 2019. This increase was driven by the 6.5 billion rand impairment charge and also accounts for post-write-off recoveries that increased to 1.4 billion. Write-offs remain conservative and increased from 7.4 billion to 8.1 billion. The 50% decline in the impairment charge to 6.5 billion rand was driven by a few important factors. These include a significantly better collections experience as clients benefited from the rate cuts in 2020, macroeconomic benefits coming through our IFRS 9 models as GDP growth forecasts improved during the period, and the decline in D7 loans. In addition, D3 loans declined further to 3 billion rand as clients either started paying or made their way into the various stages of provisioning. Judgmental and macroeconomic overlays reduced to 1.5 billion rand as they were either released into models, released through the income statement, or remain in place. Our group credit loss ratio decreased from the 2020 level of 161 basis points to 83 basis points, now back within our through-the-cycle target range of 60 to 100 basis points. This has been enabled by a reduction in credit loss ratios across all of our clusters. CRB moved to within its through-the-cycle target range of 15 to 45 basis points, with our commercial property finance portfolio continuing to perform ahead of expectations, with a credit loss ratio now down at 30 basis points. RBB moved towards the bottom end of its through-the-cycle target range of 130 to 180 basis points, but excluding some one-off benefits, the credit loss ratio was closer to the midpoint of the range. and Wealth and NAR were both slightly below their through-the-cycle target ranges. The COVID-19 and macro-related overlays we raised over the past 18 months reached a stage where the underlying overlays have either moved into our new IFRS models or did not emerge and have been released through the income statement totaling 675 million, or the risks remain in place and therefore the remaining 1.5 billion of COVID-19 related overlays. Reductions in the overlays were primarily from a 250 million rand reduction in the central provision, in CRB as D3 and D7 risks reduced, and in RBB for D3 loans that matured, and reduced overlays in forward-looking information as the environment improved. Given ongoing risks and uncertainties, new overlays were also raised in the normal course of business. From a coverage perspective, coverage across stages 1, 2, and 3 is significantly higher than the levels before COVID-19, as seen in the violet lines above the 2018 and 2019 grey bars, pointing to Nedbank being in a significantly more conservative position. Our Stage 1 coverage ratio increased marginally to 0.69% as RBB loans with higher coverage grew faster than CRB loans. Our Stage 2 coverage ratio reduced slightly to 6.4%, primarily as COVID-19 related overlays were released and the benefits from an improved macroeconomic environment. And our Stage 3 coverage ratio increased to 38%, driven by D7 loans curing and higher coverage in CRB. Shifting our focus to costs, expenses increased by 6%, primarily impacted by an increase in incentives that are aligned to the improved profitability metrics and ongoing investment in technology. Excluding incentives, expenses increased by just 2% as a result of good cost management and a focus on efficiencies and discretionary spend. Staff costs, excluding incentives, declined by 1%, reflecting the impacts of an average annual salary increase of 3.5% and a decline in headcount of 5%, largely through natural attrition, aligned to our target operating model objectives. Computer processing costs increased by 9%, and importantly, the rate of growth in the amortization charge is slowing as our managed evolution journey matures. Other costs were well managed. Although we have seen some normalization in expenses such as marketing, this was offset by declines in areas such as accommodation. With respect to our capital, our CET1 ratio increased from the 10.9% reported at December 2020 to 12.8%, driven by higher levels of profitability, RWA optimization, and partially offset by the payment of our interim dividend. Our CET1 ratio is now above the top end of the group's board-approved target range, which was revised from 10 to 12% to 11 to 12% on the 1st of January 2022. Our CET1 ratio is also above pre-crisis levels of 11.5% and well above the SARB minimum requirement of 8.5%. Going forward, we will continue with our active capital management while remaining conservative in a difficult, uncertain and volatile environment. We will retain appropriate levels of capital for growth, pay dividends as appropriately guided by the board-approved dividend cover range of 1.75 times to 2.25 times, and from time to time consider other capital management actions. At the end of 2021, we had 5.6 billion rand excess capital, measured above the top end of our board-approved CET1 range of 12%, and 28 billion rand excess above the regulatory minimum of 8.5% from 1 January 2022. On the back of the strong capital position, the group declared a final dividend at a payout ratio of 57%, which is up from the interim dividend at 40%. The return to paying dividends and an attractive dividend yield we believe should be attractive to shareholders. Lastly, before I hand over to our managing execs, the group headline earnings growth was driven by strong performances across all of our business clusters. ROE was similarly driven by increases across the clusters, with CRB and Wealth above cost of equity, RBB increasing to just below cost of equity, and NAR seeing a large rise in ROE to just below double digits. With that, Thank you. I will now hand over to Anel, who is dialing in from her office at 135 Rivonia.
Thank you, Mike, and good afternoon. CIB continued our path to recovery in 2021. Return on equity has increased to 15.3%, ahead of our forecasted trajectory to return to 2019 levels. Headline earnings increased by 54% on the back of good business performance, supported by lower impairments. Net interest income is up by 9% to 7.9 billion, as the net interest margin increased by 48 basis points, mitigating the decrease in banking advances. I will discuss this and impairments in more detail on the next slide. Non-interest revenue grew by 9% off a high base, as the private equity portfolio performed well after a difficult 2020. Trading income was down 16%, as expected from a high base in 2020 that included a once-off gain. Market conditions normalized over the course of 2021, with a particularly challenging environment in the last quarter, in line with reported global trends. We expect tough conditions to persist through much of 2022, given the inflationary backdrop, global rate cycle, and renewed geopolitical tension. Fee and commission income declined slightly by 1%, due to increased interchange fees that was somewhat negated by the continued gains made in primary bank wins. Pre-provisioning operating profit increased by 8% and is only 2% or 185 million lower than 2019 levels, noting a faster than expected recovery. Economic growth, confidence, and client activity are required to maintain this strength. Continuing on CIB's performance, the credit loss ratio decreased to 42 basis points, below expectations and within our through-the-cycle target range of 15 to 45 basis points, as risk management and improving factors in the forward-looking macro models lowered impairments. The increase in Stage 3 impairments relates mostly to a single counter, while the coverage ratio increased from 15 to 24%. Our focus on high-risk COVID-19 impacted sectors such as aviation and hospitality is top of mind, and pre-COVID stress sectors, including construction and state-owned entities, remain challenging. But we believe that adequate impairments have been raised. Banking advances have decreased by 2% from a high base, as liquidity drawdowns in 2020 were repaid. This, coupled with muted corporate demand, early and unexpected settlements, as well as our continued efforts to optimize the portfolio, led to the year-on-year decrease. However, we've seen increase in credit in the second half of the year, with banking advances growing 10% on an annualized basis, most notably in the telecoms, mining and resources, and agriculture sectors. We are committed to growing our presence in Africa, and our exposures increased 10% since December 2020 to 12% of the total book. Concerted efforts to balance income, achieve higher returns and the needs of our clients, as well as lower market volatility, resulted in a 6% reduction in capital utilization and a 9% reduction in RWA. Looking at our 4 strategic growth levers, portfolio optimization is designed to deliver value and drive deliberate and considered asset growth. This improves our ability to assess deals, to ensure that we are generating appropriate returns at a client and sector level, and enhances our agility in positioning the portfolio for emerging themes such as ESG. We believe that this enhanced agility is critical to navigating the business through complexity and maximizing our ability to deliver enhanced return on equity outcomes. We have a sustainable people plan that supports the growth of the business by aligning variable remuneration to the market, addressing the skills required to grow our business, renewing our leadership programs to build skills needed to lead an agile organization, while nurturing a culture of diversity, equity, and inclusion. Shifting to digital as the 3rd strategic growth lever. The last 2 years hastened the move to digital platforms and transformed the way we interact with our clients. Technology is integral to how we run our business, while client relationships are paramount to our success and form the basis of our warm digital approach. One example of our differentiated offering is the Nedbank Business Hub, which centers on digitizing our transactional processes to improve our client experience. It is a single, secure digital interface that enables juristic clients to apply for, maintain, and transact on their accounts in a self-serviced manner. It empowers our clients with full access to the CIB and business banking product offerings through a single platform and has been well received by our clients. We will continue our focus on technologies and optimization to transform and improve our juristic client experiences and grow our transactional banking client base. The fourth lever that I would like to discuss is our focus on sustainably investing in South Africa, as our long-term sustainability and success are contingent on the degree to which we play our role to add value and be the difference that supports the development of a sustainable society. Through our sustainable financing solutioning expertise, we have remained at the forefront of arranging innovative green funding instruments and channeling the funding towards the further development of the green economy through projects such as renewable energy and green building developments. We continue to drive the energy transition with our support of the government's renewable energy program, as well as commercial and industrial generation projects, and this is underpinned by our energy policy. We have collaborated and partnered with our clients to provide sustainability-linked financing solutions, focusing on carbon emissions, energy efficiencies, water quality, and overall ESG ratings, thereby enabling a more sustainable banking client. Turning to outlook, we are shifting to an active portfolio management approach, optimizing scarce resources, capital, people, and liquidity. Both NII and NIR are supported by a robust pipeline across multiple sectors, building on the asset growth momentum of the second half of 2021. However, conversion is a function of confidence and certainty. We aim to maintain our credit loss ratio around the midpoint of through the cycle range. The global twin challenge of inflation and growth, now coupled with more uncertainty, remains front of mind for us and our clients. We strive to make a meaningful contribution to building a strong, equitable, and inclusive South Africa. It is this focus of fulfilling our purpose to be money experts who do good that empowers and drives our people to innovate, be bold, and to lead. Thank you. And I will now hand over to Rico.
Thank you, Anel, and good afternoon, everyone. The financial performance of retail and business banking has continued to show good recovery from the impact of the COVID-19 pandemic and associated lockdown measures, with headline earnings for the year increasing by 184% to 4.532 billion rands. The main drivers of this performance were a 6% increase in revenues, as well as a 41% lower impairment charge. NII increased by 5%, driven by an increase in advances of 7%. The decrease in impairments was due to relatively lower consumer stress, driven by a strengthening macroeconomic environment. When we normalize for the net 713 million rands benefit due to the unwind of once-off credit impairment benefits relating to the curing of all accounts, as well as COVID-19 related releases of overlays, the adjusted credit loss ratio is 153 basis points. At 153, it thus falls into the middle of our through-the-cycle target range of 130 to 180 basis points. NIR grew by 8%, driven by growth in client activity, including increased levels of client spend, cash withdrawals, and purchases of value-added services. The expense increase of 6% was driven primarily by higher incentive charges as RBB's financial performance improved, but this was partially offset by the benefit of additional cost-saving initiatives. Allocated capital increased off the back of balance sheet growth, but given the much bigger higher earnings, ROE increased to 13.7%, but still remains below the cost of equity and below the levels of 2019. Turning to strategic focus, we retained our 4 strategic focus areas. These are, firstly, creating leading client experiences. We are enhancing our client value propositions in the consumer and relationship banking segments. We will also continue to enhance client journeys to build on the improvements in client experience matrix over the years. Secondly, digital first and first in digital. We have seen pleasing improvements in key digital metrics, such as the number of active Money app users and the share of our sales that are delivered through digital channels. We will continue to leverage digital to drive a lower cost operating model, as well as to improve client experience. Thirdly, an efficient and agile operating model. Project Phoenix is the capstone initiative in RBB aimed at a total restructure of our cluster into a more client-centered organization. Our second major project, Project Imagine, sees us fundamentally transform our frontline branch infrastructure to render it fit for a digital world, to be more cost-effective and to be more geared to growing market share at micro-market level. Fourth is the drive to exploring new growth vectors. These growth vectors include a focus on retail cross-sell, which has improved to 1.86, up from 1.78 in 2020. Growth through digital ecosystems such as Evo, which reached 675,000 active users at the end of December, and has just pleasingly gone past 1 million active users as of last week. Enhanced growth in insurance funeral plan sales, and deeper penetration of the opportunity presented by the township economy. We have developed various leading client innovations in line with our 4 core strategic levers. On the insurance side, we are focusing on life, funeral, as well as personal lines. On consumer health, we are focusing on Money Tracker, Credit Health, and Money Message. Our ecosystem play is underpinned by Evo, where we continue to focus on partnerships and have also added Evo vehicle sales through key dealership partners. Our Nedbank Business Hub enables clients to access products and services seamlessly through a user-friendly central point. We have also introduced a solar energy finance offering through home loans, which will assist our clients to save costs as well as to secure financing for the outlay of capital. We continue to focus on digital enablement through app and web, with a strong drive to entice clients to bank digitally with us. The number of main banked clients was up 1% to 3.1 million. This increase in main banked activity, the recovery of card spend, as well as the digitization of our client base have all driven the NIR recovery this year. We also continue to scale several key growth vector products to supplement our value proposition and to support sustainable NIR growth. Retail cross-sell has improved, driven by several purposeful cross-sell strategies, including Core Plus in the front line, as well as the use of artificial intelligence to enable next best action recommendations to our clients. Nedbank's share of main banked clients grew to 12.4%, up from 11.2% in 2020 in the annual independent consultant survey. At a growth of 1.1%, this was the fastest growth amongst the surveyed base of banks. We have now closed the share gap to just 1.2% of the average of Absa and Standard Bank. We continue to focus on arresting the decline in market share of household deposits. On the left-hand side of this slide, you will see the mix of CASA, term and notice deposits in the overall consumer deposits matrix. On the right, we have unpacked our quarterly market share movements in total, as well as by category. CASA losses were showing improvement in the last quarter of last year off the back of main banked growth, and term was improving in quarters 3 and 4 as our pricing strategy was implemented. The focus on notice deposits in the 2022 year will continue to sharpen. Sales productivity in transactional products is also growing in both digital as well as physical channels, which is supporting efforts to stem overall household market share declines. Turning to the outlook for 2022, we expect economic growth to be slower than in 2021. Despite this, we are encouraged by the multiple opportunities that the economic landscape presents, with easing COVID-19 restrictions worldwide, offering businesses some welcome reprieve. We therefore expect continued momentum in advances, with normalization of credit loss ratio to the midpoint of our through the cycle target range. We will continue to grow NIR by diversifying our revenue base and to scale key growth vector strategies whilst we continue to optimize expenses. Our client-centered growth strategy and execution plans will help us achieve our aspirations. The strong capabilities we've built over the years in digital as well as data in particular will allow us to create new and disruptive products and solutions to address clients' rapidly evolving needs and expectations, allowing us to expand access to new markets, to reduce operational costs, as well as to help us develop new revenue-generating opportunities. Our long-term focus continues to be to reduce the cost-to-income ratio and increase return on equity. Thank you. And I now hand over to my colleague, Ayolanda Ruggiero in Cape Town.
Thank you, Tiko, and good afternoon, everyone. Nedbank Wealth delivered strong growth in headline earnings of 45% to 962 million rand, with an ROE of 21%, well above the group's cost of equity. Insurance reported headline earnings growth of 77% due to improved investment performance, the implementation of an enhanced asset and liability matching strategy, partially offset by an increase in death and funeral claims in the life portfolio. Asset management delivered a robust performance with headline earnings up 12%, driven by solid growth in AUM with positive net flows and a strong market rebound. Wealth management's headline earnings increased by more than 100% as a result of credit impairment releases due to a recovery on a large single client and strong growth in investment business lines, offset by continued low interest rates, particularly in the international business. Moving on to our strategic focus areas. Nedbank Wealth remains committed to building a sustainable business by providing market-leading client experiences, building data and digital capabilities, driving long-term performance for our clients, collaborating across the Nedbank Group to increase client penetration, and investing in our people and culture. Nedbank Wealth has focused on delivering key strategic initiatives to accelerate growth. In insurance, we continue to focus on diversification and digitization of solutions by extending insurance quoting, fulfillment, and functionality on digital channels to 10 insurance solutions. The business has grown MyCover and MyCover Life solutions, launched in late 2021, to a total sum insured of almost 3 billion and more than 3 billion, respectively. In 2021, through our collaboration with consumer banking, we launched MyCover Life and MyCover Funeral solutions to Nedbank main bank clients with extremely competitive price points. Lastly, we made good traction in our mobile and digital offerings, such as the inclusion of the MyCover Life and MyCover Funeral solutions on the Eclipse platform planned for Q1 2022. Moving on to the asset management slide. In asset management, we have grown the best of breed range, which now has 270 billion rand in total AUM locally and $5.2 billion in total AUM internationally. We continue to leverage access to group distribution and digital integration by including our products on the Nedbank Money app and other digital channels. Nedgroup Investments has grown its institutional offering locally and internationally and has new mandates for the Balanced Fund, Core Range and international funds totaling approximately 3.5 billion rand. We have taken more steps in our journey towards becoming one of the leaders in responsible investing and have published the 2021 edition of the Nedgroup Investments Responsible Investments Research Report. And lastly, according to the Q4 2021 ASISA stats, Nedgroup Investments ranked 5th largest in total AUM locally with a 7% market share and 3rd largest AUM internationally, maintaining its 12% market share. Moving on to the wealth management slide. In Wealth Management South Africa, we optimized our business structure and operations through improved segment-specific client value propositions. We collaborated with the group to increase cross-sell opportunities through combined client initiatives. We work closely with Nedbank Private Wealth International to increase flows between South Africa and our international business. And lastly, we digitized key processes to strengthen system and operational controls. In our Wealth Management International business, we enhanced digital innovation and adoption through the deployment of digital signatures to improve client experience and to help reduce our carbon footprint. We collaborated with the Wealth Management South Africa business to increase flows between South Africa and our international business. And lastly, we simplified the technology landscape by investing in solutions with specific focus on digital data integration and automation. Moving on to the outlook slide. Our 2022 performance will be impacted by higher NII and widening of NIM due to improved interest rate environment and growth in our high net worth client base. Credit loss ratios remaining within the through the cycle target range, an increase in NIR due to growth in the MyCover portfolio, normalized claims trends, increased cross-sell opportunities due to penetration within the Nedbank Group, and AUM growth due to an increase in market share. We expect an increase in expenses due to investment in strategic growth initiatives, offset by cost efficiencies from the automation of key processes. The sale of the international trust business will result in a marginal loss of earnings in the short to medium term. However, we plan to utilize the proceeds from the sale to grow the remaining high net worth core business. Looking beyond 2022, Nedbank Wealth will continue to maintain a strong ROE above the group's cost of equity. Thank you. And now I will hand over to Terence at 135.
Thank you, Iolanda, and good afternoon, everyone. Headline earnings for the Nedbank Africa Regions business is up by more than 100%, with a strong performance largely driven by ETI. Overall, our NARHE is up to 594 million rands in 2021, with ROE improving to 9.3% for 2021. Although positive, our return is still below our ambition of ROE greater than the cost of equity. A closer look at our segmental performance on the right-hand side of the slide. The static operations reported an improved performance with an HE of 71 million rands, up by more than 100% from a loss of 141 million rands in the prior year. The main drivers of this performance was the decline in impairments by 62% and an increase of NII by 9%. Despite an improved second half of 2021, NIR for the full year of 2021 declined slightly by 2% due to lower transactional activity from clients and negative foreign movements. What is pleasing is that the Nedbank Zimbabwe business also reported a lower net monetary loss of 138 million rands from 205 million rands in 2020, which is a 33% improvement. And looking at ETI performance, it continues to improve, with our reported share of HE up to 523 million rands from 153 million rands, driven by strong recovery across 3 core regions, namely UMOA, which is Francophone West Africa, AWA, which is Anglophone West Africa, and CISA, which is Central, Eastern, and Southern Africa. ETI's group capital and liquidity position strengthened further, reflecting a total CAR of 14.5% at financial year end 2021, up from 12.3%, with a return on tangible equity of 18.8%, up from 0.3%. The ETI board has recommended the resumption of dividends on the back of these improved results, and Nedbank is set to receive its fair share of $40 million, amounting to just over $8 million, subject to approval at their upcoming AGM. Although profitable, Ecobank Nigeria's performance remains suboptimal and continues to be a focus of shareholders. If we take a closer look at ETI, on the graph on the top left, associate income relating to the group's 21% shareholding in ETI for the period increased significantly from 178 million rand loss in 2020 to 686 million in 2021. On the graph below, the value in use of ETI is currently greater than 2.8 billion rands, with the market value in February 2022 at around 2.4 billion, slightly higher than the carrying value as at December 2021. ETI has a very strong West and Central African franchise, having top 3 banks in 13 of 16 countries where it operates. We also saw an improvement in NPLs and liquidity, with the 3 core regions reporting lower NPLs and higher coverage ratios. And these 3 regions reported ROEs of all above 21%. While still challenging, there are signs of improvement in Ecobank Nigeria, with increased profitability and a strengthened capital position. Turning now to the strategic growth drivers of our SADC operations. Firstly, we want to do more with what we have. We'll continue to focus on growth opportunities in Mozambique, leveraging enterprise capabilities through the newly rebranded Nedbank Mozambique. We're accelerating the Africa region's digital growth strategy, leveraging group capabilities such as Avo, MobiMoney, and cross-border remittances. Last year, we won various awards, including Best Internet Banking Africa and Best Mobile Banking Africa, Most Innovative Digital Branch Design, and Digital Banking Brand of the Year in Mozambique, and Most Innovative Retail Banking App in Eswatini. Our aspiration continues to be a leader in client experience and grow our market share. In this regard, we've made great improvements, and in 2021, our Nedbank Namibia and Mozambique businesses achieved the highest Net Promoter Scores in their respective markets. Other improvements include in the top 2 positions for net sentiment in almost all the markets, and top in loyalty scores in 3 markets, namely Eswatini, Namibia, and Zimbabwe. In terms of transforming the NAR business and ensuring readiness for the future, we're focusing on 1, reconfiguring the size and shape of the business in line with the TOM 2.0 program. For example, in Nedbank Zimbabwe, we made great progress in reconfiguring the balance sheet. Nedbank Zimbabwe has completed its recapitalization to meet and comply with the minimum capital requirement of $30 million. We're also in the process of exploring the integration of the NAR business with group technology ecosystem to achieve increased efficiencies and product consistency. Turning to our outlook for Africa regions. Economic growth in sub-Saharan Africa is forecast to accelerate slightly to 3.7% in 2022 and rise further in 2023. For 2022, we expect to build on the NAR business performance in 2021. Of course, risks remain. New COVID variants, socioeconomic and political issues across the continent may still negatively impact African economies and, in turn, our business performance. That said, rising commodity prices will likely benefit commodity-driven economies. Performance in the SADC operations for 2022 is expected to continue to improve year on year. Our key focus areas for this year are to continue to transform our NAR business and its operating model, maximizing the Mozambican opportunities through Nedbank Mozambique, accelerating and implementing our Africa digital growth strategy, leveraging our overall group capabilities. From our ETI investment perspective, we expect improved earnings in 2022, as evident in their recently released full year 2021 results. We are determined to continue increasing the flows between our 2 banks and work with the other major shareholders to resolve the challenges in Ecobank Nigeria to increase shareholder value. In the medium to long term, we expect Nedbank Africa Regions to continue to grow its overall contribution to group earnings. We aim to meet and exceed the ROE target of greater than cost of equity. Thank you, and I'll now hand you over to Mike Brown, who will cover the outlook and make some concluding remarks.
Thank you, Terence. In closing, I will provide our outlook for 2022 and beyond and reflect on the progress that we have made towards meeting our medium-term targets to end 2023, with a key takeout for investors being that our diluted headline earnings per share target is now expected to be reached in 2022, a year earlier than previously expected. Starting with our current macroeconomic outlook that informs our guidance and targets, and knowing that the events in Russia and the Ukraine in recent weeks increase risks in any forecasts, particularly with respect to inflation, interest rates, and economic growth. Our group economic unit's GDP forecasts highlight the better than initially expected economic growth in 2021 off the low 2020 base. Growth into 2022 and beyond, however, is expected to be lower than we previously thought and remain muted at below 2%. Given global inflationary pressures and expected monetary policy responses, particularly in the US, South African interest rates have shifted into an upward cycle. And in addition to the 25 basis point increase in January this year, we currently expect a further 100 basis points of increases in 2022, and then a further 50 basis points in each of 2023 and 2024, respectively. Industry-level credit growth was slow in 2021 at just over 2%, and materially below our initial forecasts of around 5%. But this is, however, expected to recover in 2022 to around 4 to 5%. South Africa's fiscal position remains challenging, but has been better than expected over the past 12 months, as the country benefited from a strong commodity cycle and improved tax collections. As highlighted in the budget speech, care will be needed to ensure that this cyclical outperformance in tax revenue is not used to structurally lift the already high government expense base. Using our economic outlook as a base, this slide shows our usual format of shorter-term line-by-line guidance for the full year 2022. For NII in the top left, after growing 8% in 2021, we currently expect NII growth in 2022 to be upper single digits. We expect this growth will be driven by the ongoing momentum we see in RBB lending, with some recovery in CIB lending. The benefit in endowment from 125 basis points of expected interest rate increases, and as a result, continued expansion of our net interest margin. Our credit loss ratio, which was 83 basis points in 2021, is expected in 2022 to be in the top half of our through-the-cycle target range of 60 to 100 basis points. That is somewhere between 80 to 100 basis points, and we remain conservatively provided as the COVID impact on our clients reduces over time. With regards any exposure to the Ukraine and Russia, as a bank focused on the African continent, we have no direct exposures in these geographies, and any indirect exposures to clients who themselves have operations in these geographies are immaterial. Non-interest revenue growth is expected to increase in 2022 and be around upper single digits, helped by both client activity as well as the non-recurrence of the fair value debits in the 2021 base. Expenses, as always, will remain tightly under control, but are expected to grow above mid-single digits, primarily as the expected introduction of new regulatory costs, such as deposit insurance and Twin Peaks, are only partially offset by cost savings through TOM 2. As a result of this guidance, taken together, we would currently expect DHEPS growth in 2022 to be above nominal GDP plus 5%. Capital levels are expected to remain strong and above the top end of our board-approved target range, and dividends are currently expected to be declared within our target range of 1.75 to 2.25 times cover. Looking further out now than 2022, our medium-term targets that we set for end 2023 relating to DHEPS, ROE and cost-to-income ratio, as well as net promoter score, remain unchanged, and meeting them should support ongoing shareholder value creation. Given the strong performance in 2021 and good progress on strategic and operational delivery, we believe that our 2023 DHEPS target of above 25.65 Rand should now be achieved a year earlier, that is, by the end of 2022. Achieving our end 2023 ROE target of above 15%, a cost-to-income ratio of less than 54%, and a net promoter score of number 1 ranked all remain appropriately stretched and ambitious targets. But since we are a year closer and following a strong 2021 performance, confidence in meeting them has increased. Beyond 2023 and in the longer term, as our clients emerge from the impacts of COVID and as interest rates rise from historic lows, from diligently executing on our strategy, we see further opportunity to increase our ROE to above 18% or cost of equity plus 3 or 4, as well as reduce our cost-to-income ratio to below 50%, while sustainably growing DHEPS at 5% above nominal GDP per annum. In closing, and as I said at the interims, I'm pleased that we can conclude the resilience phase of our post-COVID strategy with key balance sheet ratios on capital, liquidity and coverage, all at or above the top end of board targets and above pre-crisis levels, enabling the resumption of dividend payments to shareholders. Our people are at the centre of our business, and we are working on bringing more staff back into the office in a COVID-safe manner, while upskilling and enabling staff to continue to deliver great client experiences. We believe our strategy remains appropriate and delivery is progressing well. In particular, we continue to focus on the successful finalisation of the last pieces of our IT platform digitisation, known as Managed Evolution, that is absolutely central to our future competitiveness in financial services. Client satisfaction metrics continue to improve and remain top of mind as we aim to be number 1 among South African banks. As we roll out more and more Managed Evolution functionality, the unlocking of benefits from TOM 2 should accelerate, and progress on leveraging our balance sheet to grow clients' transactional income and transactional deposits through SPT 2.0 should also improve. We will continue to create positive impacts in the societies where we operate as we use our financial expertise to do good for all stakeholders, and at the same time participate and lead in new financing opportunities aligned to the United Nations SDGs and maintain our leadership position on ESG matters generally. Lastly, we'll continue to focus on value creation for shareholders through ongoing DHEPS growth, ROE and efficiency improvements, combined with attractive growth in dividend payments. Thank you, and may you and your loved ones stay healthy and safe.